US Treasury bonds are called the safest investment in the world, but safe does not mean painless. For decades, bond investors lived in a world where interest rates mostly moved lower. Falling yields created rising bond prices. That world may be gone. Higher for longer yields could become the new normal, and that will not affect bonds only, but stocks and other assets as well. Long-term US Treasuries investors have already learned the hard lesson. When yields rise, bond prices fall, and the longer the maturity, the deeper the damage. The warning is growing louder. The 30-year bond bull market may be over. The question is not whether US Treasuries are credit safe. The question is whether investors are being paid enough for the duration risk, inflation risk, and fiscal risk they now carry. Long-term bonds are more sensitive to interest rate changes. A small move in yield can create a large move in price. Yes, US Treasuries still pay interest income, but income does not protect investors from mark-to-market losses when long yields keep rising. The central problem is America's fiscal issue. By July 2026, gross national debt had reached about $39.4 trillion US dollars. The federal deficit approached $1.4 trillion US dollars in the first 9 months of fiscal 2026, roughly $155 billion US dollars of borrowing every month. Since 2007, the US Treasury market has ballooned from about $4.5 trillion US dollars to $39.4 trillion US dollars. Debt as a percentage of US gross domestic product has doubled and now exceeds 100%. Years of excessive spending have pushed annual federal interest costs above $1 trillion US dollars. Financing these deficits requires relentless Treasury issuance. When supply grows faster than demand, prices must fall and yields must rise to attract buyers. This creates a dangerous feedback loop. Higher yields increase interest costs, which enlarge deficits, which require even more borrowing. Inflation adds another threat. Oil shocks, tariffs, strong economic activity, and questions about Federal Reserve independence could keep inflation above target. Markets have shifted from expecting rate cuts toward considering further increases. Hoisington Investment Management, a US Treasuries bull for more than 3 decades, now believes long-run inflation could migrate toward 3.5% to 4.5%, with episodes above 5%. That is far above the Federal Reserve's 2% target, and it changes the mathematics of long-term bonds. If inflation stays higher for longer, investors demand higher yields to protect their real returns. AI is now competing for capital. Technology companies are issuing enormous quantities of long-dated debt to finance data centers, chips, and power infrastructure. Investors must absorb this corporate borrowing alongside expanding government issuance. The 30-year US Treasury yield remained above 5% for an unusually long period, after approaching 5.2% in May, its highest level since 2007. Professional investors are responding. Hoisington cut its US Treasuries portfolio's effective duration from 20.88 years in September 2025 to less than 1 year by June 2026. Its long-duration strategy had suffered annualized losses of 8.7% over 5 years. Jupiter Asset Management went further, cutting US Treasuries exposure to zero in a major bond fund. Jupiter preferred European and emerging market debt, arguing that overheating and inflation made US rate increases more likely. The risks extend beyond bond portfolios. Higher US Treasury yields raise mortgage costs. They also raise corporate borrowing costs, pressuring leveraged businesses and weakening profit margins. Property markets and highly leveraged companies are especially vulnerable when the cost of money rises. Higher US yields can strengthen the dollar and make dollar debts harder for emerging markets to service. Sudden yield increases may also expose losses at banks, insurers, and pension funds. This argument assumes that ballooning US fiscal deficits will not depreciate the dollar, while Treasury yields are increasing. That is a major question, and a topic we will discuss in another video. For investors, the implications go far beyond bonds. Persistently high US Treasury yields make government debt more competitive with stocks. Higher yields raise the discount rate applied to future corporate earnings, which can compress equity valuations. That pressure is especially dangerous for expensive technology and other growth stocks. US Treasuries still provide income and credit safety, but a more resilient approach may require shorter maturities, diversified bond holdings, and caution toward heavily indebted countries and companies. Higher for longer US Treasury yields are a new risk for both global stock and bond markets. This change will not happen overnight, but it will become more obvious over time. Long-term investors should consider it a basic assumption when building portfolios for the years ahead. If you want to stay informed about the latest premium investment, business and financial intelligence, subscribe to the Global Ledger and tell us in the comments, what would you do with higher for longer US Treasury yields in your investments? Until next time, follow the intelligence.